In the world of finance, numbers tell a story. They paint a picture of a business's health, its potential, and its journey. But what ensures these numbers are a true reflection of reality? What guarantees the story they tell is honest and reliable? The answer lies in two fundamental pillars: ethics and integrity. Ethics in finance isn't just about following rules, it's about doing what is right. It's about being honest, transparent, and fair in all your dealings. Integrity is the backbone of this ethical conduct. It means upholding moral principles even when no one is watching and ensuring your actions align with your words. These principles form the bedrock of the financial world. They are not optional extras, but essential elements that underpin the entire financial system. Trust is the lifeblood of finance, and ethical behavior is what builds and maintains that trust. Without ethics and integrity, the financial system would crumble. Imagine a world where companies could falsify their accounts without consequence, where financial advisors prioritize their own gain over their clients' well-being. Such a system would be riddled with uncertainty and risk, making it impossible for businesses to function and economies to thrive. Ethical standards provide a framework for ethical conduct in finance. These standards are not merely suggestions. They are principles that every financial professional is expected to uphold. They offer guidance in navigating complex situations and making decisions that are morally sound. One of the most fundamental ethical standards is integrity, being honest. Financial professionals are entrusted with sensitive information and are responsible for managing assets on behalf of others. Honesty in all aspects of their work, from financial reporting to client interactions, is paramount. Confidentiality is another crucial ethical standard. Financial professionals often have access to confidential information about individuals, businesses, and investments. Protecting this information is not just a legal obligation, but also an ethical imperative. Objectivity and impartiality are also key. Financial professionals must be able to make decisions based on facts and analysis, free from bias or personal gain. This means providing impartial advice, even if it's not what the client wants to hear, and avoiding conflicts of interest that could compromise their judgment. Finally, professional competence is an ethical standard that underscores the importance of continuous learning and development. Financial professionals have a responsibility to maintain their skills and knowledge and maintain professional behavior, ensuring they are equipped to provide the highest level of service to their clients and stakeholders and paying due care in their work. Ethical standards are not just abstract concepts, they have tangible impacts on the financial world and those who operate within it. When upheld, these standards foster trust, promote stability, and drive sustainable growth. For individual professionals, adherence to ethical standards is crucial for building a solid reputation and a successful career. In an industry where trust is paramount, a reputation for ethical conduct is invaluable. Conversely, ethical breaches can lead to reputational damage, legal ramifications, and even the loss of one's professional license. Beyond individual impact, ethical standards underpin the integrity of the entire financial system. When financial institutions operate ethically, it builds confidence in the market. Investors are more likely to invest, lenders are more likely to lend, and businesses are more likely to thrive when they trust that the system is fair and transparent. Moreover, ethical conduct contributes to the long-term sustainability of the financial industry. By considering the wider impact of their decisions, financial professionals can help ensure that the pursuit of profit does not come at the expense of social responsibility and environmental sustainability. In essence, ethical standards are not just rules to follow, they are the guiding principles that ensure the financial world operates fairly, transparently, and responsibly. By embracing these standards, financial professionals contribute to a more stable, trustworthy, and sustainable financial system for all. While ethical standards set the moral compass, regulations and compliance provide the legal and practical framework within which the financial world operates. These rules and guidelines are designed to ensure fairness, transparency, and accountability in all financial activities. In the realm of accounting, regulations like the International Financial Reporting Standards, or IFRS, ensure consistency and comparability in financial reporting across different countries. These standards dictate how companies should record, report, and disclose their financial information, providing a common language for investors and stakeholders to understand a company's financial health. Tax regulations, on the other hand, govern how individuals and businesses contribute their fair share to the public purse. These regulations are complex and vary significantly from country to country, covering aspects like income tax, corporate tax, value-added tax, and capital gains tax. Compliance with these regulations is not optional. Financial professionals and institutions must stay abreast of the ever-evolving regulatory landscape and ensure their operations and activities adhere to all applicable rules and guidelines. Regulatory bodies have the power to investigate and penalize those who fail to comply, making compliance non-negotiable. Section 5. Applying standards and regulations, real-world scenarios. How do financial professionals navigate this landscape of ethical standards and regulations in their daily work? Let's look at some real-world scenarios. Imagine you are an accountant preparing a company's financial statements. You discover an error that, if corrected, would significantly reduce the company's reported profit. The company's management is under pressure to meet earnings targets. What do? Ethical standards of honesty and integrity dictate that you must report the error accurately, regardless of the pressure to do otherwise. Now, envision yourself as a financial advisor recommending an investment product to a client. You know that a different product, one that pays a lower commission, would be more beneficial for the client's long-term financial goals. Ethical standards of objectivity and putting the client's interests first require you to recommend the product that aligns with their best interests, even if it means a lower commission for you. These scenarios demonstrate that applying ethical standards and regulations is not always straightforward. It requires careful consideration, sound judgment, and the courage to do the right thing, even when faced with pressure or temptation to do otherwise. Section 6. Adding value. Ethical conduct breeds success. In the competitive world of finance, it might be tempting to view ethical conduct as a constraint, a hurdle to overcome in the pursuit of profit. However, this view is short-sighted. In reality, ethical conduct is not a hindrance to success. It is a catalyst for sustainable growth and lasting value creation. Ethical behavior builds trust, and trust is the foundation upon which successful business relationships are built. Clients are more likely to entrust their financial well-being to professionals and institutions with a proven track record of ethical conduct. This trust translates into client loyalty, positive word-of-mouth referrals, and a stronger brand reputation, all of which contribute to long-term business success. Moreover, ethical conduct mitigates risk. By adhering to regulations and upholding ethical standards, financial institutions reduce their exposure to legal, reputational, and financial risks. This proactive approach to risk management creates a more stable and sustainable business environment, attracting investors and fostering confidence in the market. Ultimately, ethical conduct is not just about avoiding negative consequences, it's about creating a positive impact. By conducting business with integrity, financial professionals contribute to a fairer, more transparent and trustworthy financial system, benefiting not only themselves and their clients, but also the wider economy and society as a whole. Section 7. Leadership in finance. Setting the ethical tone. Leadership in finance extends beyond financial acumen and business strategy. It encompasses the crucial role of setting the ethical tone for the entire organization. Ethical leaders are not just figureheads, they are role models who embody the values of integrity, transparency, and accountability in their every action. Leaders set the ethical standard by example. Their behavior, decision-making, and interactions with powerful message about the organization's values. When leaders consistently demonstrate ethical conduct, it creates a culture where ethical behavior becomes ingrained in the organization's DNA. Effective leaders communicate the importance of ethics clearly and consistently. They ensure that ethical standards are not merely written policies, but are understood and embraced by every member of the team. This includes providing training, fostering open dialogue, and creating safe channels for reporting concerns without fear of retaliation. Moreover, ethical leaders empower their teams to make ethical decisions. They create an environment where employees feel comfortable speaking up when they witness unethical behavior and are encouraged to raise ethical concerns without fear of retribution. This culture of openness and accountability is crucial for fostering a truly ethical workplace. Section 8. Communication, transparency, and trust. In the intricate world of finance, communication is not merely about conveying information, it's about building trust through transparency and clarity. Ethical communication is honest, accurate, and timely, ensuring that stakeholders have the information they need to make informed decisions. Transparency in financial reporting is paramount. It's about providing clear, accurate, and timely financial information that reflects the true financial position of a business. This includes disclosing both positive and negative information, even when it's not legally required, to provide stakeholders with a complete and unbiased picture. Effective communication also involves listening attentively to stakeholders' concerns and responding to their queries promptly and transparently. This open dialogue builds trust and fosters stronger relationships, demonstrating that their perspectives are valued and their concerns are taken seriously. In an age of digital communication and social media, maintaining ethical communication standards is more crucial than ever. Financial professionals must be mindful of the information they share online and ensure that their communications are accurate, compliant with regulations, and respectful of client confidentiality. Section 9. Conclusion, upholding the integrity of finance. As we've explored throughout this guide, ethics and integrity are not optional extras in finance. They are the very foundation upon which the entire financial system rests. Upholding these principles is not just a matter of following rules, it's about doing the right thing even when it's difficult and acting with integrity in every decision and action. By embracing ethical standards, adhering to regulations, and communicating transparently, financial professionals build trust with clients, foster stability in the markets, and contribute to a more sustainable and responsible financial world. Remember, every decision you make, every action you take shapes the ethical landscape of finance. Choose to be a force for good, a champion of integrity, and a steward of trust in this vital industry. The future of finance depends on it.